What's up, everybody? It's Financial Freedom here. Today, we're diving into 10 timeless investing rules from John Bogle, the founder of Vanguard. So, buckle up, grab a pen and paper, and let's unlock the secrets to financial success with John Bogle's 10 timeless investing rules. Rule number 1, and arguably the most important, is to invest for the long term. This means thinking beyond the immediate future and focusing on the bigger picture. When you invest with a long-term perspective, you give your investments the time they need to grow and weather the inevitable ups and downs of the market. Time is your greatest ally in investing. The longer you stay invested, the more opportunities your money has to grow. This is because the market tends to reward patience and long-term commitment. The longer your money compounds, the more it grows. Compounding is the process where the earnings on your investments generate their own earnings. Over time, this can lead to exponential growth. Think of it like planting a tree. It starts small, but grows strong over time. Just as a tree needs time to develop deep roots and a sturdy trunk, your investments need time to grow and mature. This is the power of compound interest at work. By reinvesting your earnings, you allow your money to work for you, creating a snowball effect that can lead to significant wealth over the long term. A small amount invested consistently over decades can grow into a substantial sum. It's not about how much you invest at once, but about being consistent and patient. Regular contributions, no matter how small, can add up over time. The stock market is a marathon, not a sprint. Just like a marathon runner needs endurance and strategy, an investor needs patience and a long-term plan. Short-term market fluctuations are normal, but they shouldn't deter you from your long-term goals. So, ditch the get-rich-quick schemes and focus on building a solid foundation for your financial future by playing the long game. Remember, true wealth is built over time, not overnight. Stay committed, stay patient, and let time work its magic on your investments. John Bogle's second rule is refreshingly simple. Embrace simplicity. Don't get caught up in picking individual stocks or chasing investment fads. Focus on low-cost, diversified index funds. Picking individual stocks is like finding a needle in a haystack. Index funds, on the other hand, are like buying the entire haystack. They track a market index, giving you a diversified basket of companies. Index funds are like the autopilot of investing. Set it and forget it. Embrace the simplicity of index funds to build wealth over time. When it comes to investing, every dollar counts. Each dollar you save on fees is a dollar that stays in your pocket, working for you. Over time, these savings can compound, significantly boosting your overall returns. John Bogle's third rule is to minimize costs. Bogle, the founder of Vanguard, revolutionized the investment world by emphasizing low-cost index funds. His philosophy was simple. Keep costs low to maximize returns. Fees are like termites, silently eating away at your returns. Just as termites can cause significant damage to a house over time, high fees can erode your investment gains, leaving you with much less than you anticipated. Even small differences in fees can make a huge difference in your long-term wealth. For instance, a 1% difference in fees might seem negligible, but over decades, it can result in tens of thousands of dollars in lost returns. Imagine you invest $10,000 and earn a 7% average annual return. This scenario assumes a steady growth rate, which is quite realistic for a diversified portfolio over the long term. With a 2% fee, your investment grows to about $27,000 in 20 years. This fee might not seem like much initially, but it significantly reduces your overall returns. But with a 0.05% fee, it balloons to over $38,000. This stark difference highlights the importance of minimizing fees to maximize your investment growth. So, be fee conscious and choose investments with the lowest possible costs. By doing so, you ensure that more of your money is working for you, helping you achieve your financial goals faster and more efficiently. Chapter 4. Stay the course. The stock market is like a roller coaster with ups and downs. It can be thrilling and terrifying at the same time. One moment, you're on a high, and the next, you're plummeting down. This volatility can make even the most seasoned investors feel uneasy. But remember, the key is not to let these fluctuations dictate your actions. John Bogle's fourth rule is crucial. Stay the course. Bogle, the founder of Vanguard, emphasized the importance of maintaining a steady investment strategy. He believed that trying to time the market or reacting to short-term changes could be detrimental to long-term success. Investing is a long-term game, and it's easy to get caught up in market fluctuations. The daily news can be overwhelming, with constant updates on market movements. However, it's essential to focus on the bigger picture. Over time, the market has shown a tendency to grow, despite short-term setbacks. Panic is not an investment strategy. When the market takes a downturn, the instinctive reaction might be to sell off assets to avoid further losses. But this often leads to missing out on the eventual recovery. Instead of panicking, take a deep breath and remind yourself of your long-term goals. History shows that the market rewards those who stay invested for the long term. If you look at historical data, you'll see that despite numerous downturns, the market has consistently bounced back and grown over the decades. Those who remained patient and stayed invested reaped significant rewards. Think of the 2008 financial crisis. Those who stayed the course were rewarded with a remarkable recovery. The crisis was one of the most challenging times for investors, but those who held on to their investments saw substantial gains in the following years. It was a testament to the power of patience and resilience. Don't let fear or greed dictate your investment decisions. Emotional reactions can lead to poor choices, such as selling in a panic or buying in a frenzy. Instead, stick to your plan and make decisions based on logic and research. Stay focused on your goals and ride out market fluctuations. Just like a ship navigating through a storm, you need to stay on course and trust in your long-term strategy. By doing so, you'll be better positioned to achieve your financial objectives and weather any market turbulence. Chapter 5. Diversify. Diversification is key in investing. John Bogle's fifth rule is to diversify your investments across different asset classes. Don't put all your eggs in one basket. A well-diversified portfolio includes a mix of stocks, bonds, and international investments. Stocks offer growth potential, bonds provide stability, and international investments give exposure to different markets. By diversifying, you're spreading your risk and protecting yourself from potential losses. Diversification helps you weather market storms and reduce volatility. It's like having a financial safety net. Chapter 6. Don't try to beat the market. John Bogle's sixth rule, don't try to beat the market. It's incredibly difficult to consistently outperform the market over the long term. Most actively managed mutual funds fail to outperform their benchmark indexes. Trying to time the market is a losing strategy. Focus on what you can control: costs, asset allocation, and emotions. Embrace low-cost index funds designed to match the market's return. Chapter 7. Keep emotions in check. Investing is as much about psychology as it is about numbers. John Bogle's seventh rule, keep your emotions in check. Fear and greed can derail even the best investment plans. When the market is booming, greed takes over. When it corrects, fear sets in. Control your emotions and avoid impulsive decisions. Have a well-defined investment plan and stick to it. Don't let market noise distract you from your long-term objectives. Time is on your side. Stay focused on your goals. John Bogle's eighth rule. Focus on asset allocation. Asset allocation is how you divide your investments among different asset classes. The right allocation depends on your risk tolerance, time horizon, and financial goals. Younger investors might allocate more to stocks. Those closer to retirement might prefer bonds. Your risk tolerance is like your spice tolerance. Find what you're comfortable with. Your time horizon is like the length of your journey. Choose investments accordingly. For short-term goals, choose less volatile investments. For long-term goals, you can afford to take on more risk. John Bogle's ninth rule, rebalance when necessary. Rebalancing is buying and selling assets to maintain your target allocation. Over time, your portfolio can drift from its original allocation. Rebalancing helps maintain your desired risk level. It's like keeping your car aligned. Regular rebalancing keeps your investments on track. Some investors rebalance on a set schedule. Others rebalance when allocation drifts outside a certain range. The best approach depends on your preferences and strategy. Stay disciplined and maintain your desired asset allocation. John Bogle's 10th rule. Remember what's most important. Investing is not just about making money, it's about achieving your financial goals. Remember why you started investing: to retire early, buy a home, provide for your family, or leave a legacy. Let your goals guide your investment decisions. Investing is a marathon, not a sprint. Stay focused on your long-term goals and avoid short-term noise. Time is your friend. Impulse is your enemy. There you have it. John Bogle's 10 timeless rules for investing success. Let's recap. 1. Invest for the long term. 2. Embrace simplicity. 3. Minimize costs. 4. Stay the course. 5. Diversify. 1. Don't try to beat the market. 1. Keep emotions in check. 1. Focus on asset allocation. 9. Rebalance when necessary. 1. Remember what's most important. By following these principles, anyone can secure their financial future. Investing doesn't have to be complicated. Reflect on your own investing habits and start implementing these principles today. Watch as your financial future transforms.